This video is over the limits to the use of debt in capital structure. I'm your professor, Dr. Stephen Haggard. If we think back to Modigliani and Miller's prediction about the value of the firm, including taxes, then the tax deductibility of debt increased the value of the firm. Logically, that would lead us to the conclusion that we should use as absolutely much debt in the firm as possible. That's not what we see in the real world, and so there has to be something else acting in opposition to that to achieve the sorts of results that we see in actual firms. And those things that we're going to talk about are the limits to the use of debt. These are the things that keep firms from being able to run on nearly 100% debt. Let's talk about the costs of financial distress. Now, all bankruptcy is financial distress, but not all financial distress results in bankruptcy. And so this is something to keep in mind as we move forward. Well, let's talk about the direct costs of bankruptcy. First of all, there are the legal and administrative costs. In a bankruptcy, everybody has to have a lawyer. The company has a lawyer, and certainly the creditors must have lawyers. And lawyers are not cheap. This is why people want to be lawyers, because lawyers get paid a lot of money. And then we also have the administrative costs. The judge is going to appoint someone called a bankruptcy trustee. And it's the job of the bankruptcy trustee to get absolutely as much value for the firm, for the creditors, as they possibly can. And the bankruptcy trustee is usually a lawyer and will have a staff of people working for them. And all of these people are professionals who expect to get paid. And so those are our direct costs of bankruptcy. But those are actually probably fairly small compared to the indirect costs of bankruptcy. First of all, let's talk about the impaired ability to conduct business. If someone finds out that you are in bankruptcy or are about to go bankrupt, would that supplier continue to want to send product to you? Probably not. We've seen this again and again. I'll give the example of linens and things. It was a home goods store, and they got into some financial distress, and their suppliers found out about it. And their suppliers started saying things like, "We'll send you those towels when you send us a check." Usually they had been getting 30 or 60 or 90 days to pay their bills. Well, now suddenly they're having to pay cash for everything, and that definitely crimped their business and actually led to their eventual liquidation. And then there is the reputation of the firm. Do you really want to work for a bankrupt firm or a firm that is entering bankruptcy or exiting bankruptcy? There's a stigma to working for a loser firm, and so people will not want to work there. And then finally, let's talk about the impact on your consumers. We'll give an example here from the late 2000s. The American automotive industry was in trouble, and 2 of the 3 American automakers first accepted bailouts from the government and then eventually went bankrupt. The Ford Motor Company saw the trouble coming and had stacked up some cash prior to the situation and was able to make it through without taking a government bailout or going bankrupt. And afterwards, you would hear things like people calling GM government motors in a condescending kind of way, because they looked down upon the firm for not being healthy enough to make it through on its own. In fact, the other day in traffic, I saw a pickup from this era. It was a Ford pickup truck, and on the side it said, "No Bailout Edition." Apparently the owner took a great pride in the fact that Ford did not take a bailout. Okay, now let's talk about agency costs. Agency costs result from the separation of ownership and control, or basically when anyone has control over money that is not their own. We know that people are scumbags, and people will act to enrich themselves at the expense of other people. We see managers acting to enrich themselves at the expense of shareholders. We see managers and shareholders acting to enrich themselves at the expense of debt holders. And so we're going to talk about 3 strategies that such scumbags might use. First of all, we're going to talk about the incentive to take large risks. If you're already losing the football game, it might be worth your while to try to throw the football in what we call a Hail Mary pass. If you're going to lose if you don't, so you go ahead and try to throw the ball. Now, in football, there's no harm in doing this, but we will see that in finance there is. And then there's the incentive toward underinvestment. We're going to see that it's actually in the interest of shareholders, or it might be in the interest of shareholders, to reject positive NPV projects if the firm has debt and is in financial distress. And finally, we're going to talk about milking the property. This is where we try to extract every bit of value that we can from the firm and pass it along to the shareholders in the form of dividends or repurchases prior to declaring bankruptcy. And once again, of course, this helps the shareholders at the expense of the debt holders. So let's start with an example here of a company in distress. This is a balance sheet. And it's a special kind of balance sheet because it shows both book values and market values. Now, the book values look pretty good. We have $200 in cash and $400 in fixed assets for total assets of $600. And the firm has a debt-to-equity ratio of 1. It's funded $300 with debt and $300 with equity. So everything looks good. But let's take a look at the market values. Of course, the market value of cash is the same as the book value of cash. But check out the market value of those fixed assets. Now, how could that be? Well, first of all, the company might have had a disaster where all of its fixed assets were wiped out and there was no insurance to replace those fixed assets. For example, during hurricanes, entire businesses can be wiped out, and if they do not have insurance, this would be what their balance sheet would look like. And then over on the other side, we see the market values of the debt and the equity. Now notice that the total value of the assets is now $200, so the value of the debt and the equity must also be equal to $200. Well, we know that the debt holders get paid first, and so anything up to $300 is going to go to them. And since we only have $200 in market value of assets, that's going to go entirely to the debt holders. Well, what does that leave for the equity holders? Nothing. In fact, we could have up to $299 or $300 in market value of assets, and the equity holders would still get nothing. Once the market value of the assets crosses 300, let's say it was 400, then we would have 300 going to the debt holders and 100 going to the shareholders. But there's a huge range of market values of the firm for which the equity market value is 0. So given the financial distress the company is experiencing and given the capital structure the company has, let's talk about selfish scumbag strategy number 1, which is taking excessive risks. You might also hear this referred to as the Hail Mary pass. And so let's talk about this gamble that the firm might take. There is a 10% chance that they're going to win big, in which case there will be a payoff of $1,000. But of course that means there's a 90% chance that they'll lose and get nothing. What's the cost of the investment? It's $200, which just so happens to be the entire amount of cash that the firm has on hand. The required return is 50%, and you say, wait a minute, that's much higher than anyone would ever expect. Well, keep in mind that return and risk must go together, and this is an incredibly risky gamble, so of course the required return is high. So what is the expected cash flow from the gamble? Well, there's a 10% chance the payoff will be 1,000, and there's a 90% chance the payoff will be 0. And so if we take 10% times 1,000 plus 0% times 90, or 0 times 90%, we can see the expected payoff is 100. So we could easily figure the net present value of this project. Minus 200 is our initial investment plus the present value of the future cash flows. Well, here there's only one future cash flow that takes place 1 year into the future, and that is 100. Divide by 1 plus r, which is 1.5, gives us an NPV of negative 133. Now, we know that we should not accept negative NPV projects. And in normal times, especially for an all-equity firm, nobody would think this was a good idea. But we're going to see it might be a good idea for the shareholders. Let's take a look at how this gamble would affect the bondholders and the stockholders. So the expected cash flow from the gamble to the bondholders would be $300 if we win. However, that's only a 10% chance of happening. So we're going to say 300 times 0.10 plus 0.90 times 0 if we lose. Now, why is that? Because we took the last $200 from the firm to make this gamble. If we had not gambled that money away, the bondholders would have gotten $200. And so when we do the math, we can see the expected cash flow at time 1 from this gamble is 30. That's to the bondholders. Now, what about to the stockholders? Well, if we win, we get our 1,000 and we pay our 300 to the bondholders to make them whole. And then we would multiply that by 0.10 though, because there's only a 10% chance that that outcome is going to happen. The other 90% is an outcome of 0 for us because we've lost everything. And so the expected cash flow to the stockholders from this gamble is 70. And so now we need to realize, though, that those things are happening at time 1. And so the expected present value to the bondholders of this gamble is $20. And the expected present value of this gamble to the shareholders is $47. Now, who wins and who loses? Well, if we hadn't taken the gamble, the bondholders would have gotten 200, but now they can only expect to get 20, so they are down by 180. The stockholders weren't going to get anything, but now they have an expectation of $47. And so we've imposed a loss of 180 on the bondholders, an expected loss of 180 on the bondholders for an expected gain of 47 to the shareholders. Now that is truly a scumbag move. So now let's talk about selfish scumbag strategy number 2, and it's called underinvestment. So we're going to consider a government-sponsored project that guarantees $350 in 1 year. Why do we say government-sponsored project? Because we want to make sure that it's got this risk-free smell about it. So the cost of the investment is $300. So the firm only really has $200 right now. That means the shareholders are going to have to chip in an additional $100 to finance the project. And the required return on this project is 10%. Notice this is much lower than the last project we discussed because, after all, this is a safe government-sponsored project. So we can easily figure out our net present value. It's equal to the negative 300 that we have to invest plus the present value of the 350 that we will get at the end. And so the net present value of this project is $18.18. Now, NPV theory and the goal of financial management tells us we should always accept such a project. But once again, the agency problem and the capital structure of the firm tell us that maybe this isn't the best outcome for the shareholders. So what are the expected cash flows of the government-sponsored project? Well, to the bondholder, it's 300. It means that they get the 200 that they already had plus another 100. So the bondholders would be very pleased to see us take on this project. But what would it be to the shareholders? The stockholders would be getting 350 minus 300. And so the cash flow to them would be $50. The present value of that $50 minus 100 gives us the present value of the stocks with the project. And so it would actually be negative. And the reason is that these people are having to invest additional money in order to make this happen, but 100 of the benefit is going to the bondholders. And so there's really not much interest in the shareholders. In fact, there's zero interest in the shareholders to make this investment because, frankly, it only helps the bondholders. Here's selfish scumbag strategy number 3, milking the property. So let's talk about how we could milk the property. Well, we could do what's called a liquidating dividend. We could see the handwriting on the wall and know that our firm's going to go bankrupt. So what could we do? We could take all the cash we currently have and pay it out as a big old dividend to our shareholders. Now that leaves the firm insolvent and it leaves the bondholders getting nothing. But it leaves plenty for the former shareholders. Now, it's probably, hopefully, this is a violation of some bond indenture, which would give the bondholders legal basis for suing, but there are bond contracts out there that don't have limitations on paying out dividends. So you've got to read the fine print before you see a bond, or you might get taken advantage of in this manner. Now let's talk about what else could go on here. Increasing perquisites to shareholders and or management. First of all, let's talk about what perquisites are. That's really the non-monetary part of the things that you get as part of your job. And so let's just talk about salespeople. Salespeople get to travel, and that could be considered a benefit. And they get to stay in hotels, probably not the cheapest hotel, and they get to eat expensive meals out with clients. These could all be considered perquisites. And if we think on a bigger scale, we could think of corporate headquarters, such as Apple's new spaceship headquarters out in California, which, by the way, is mostly vacant now. Or you could think about company jets. Corporate jets are a big perquisite. And a lot of times what we see is that firms will, based on their capital structure, may have different tastes for perquisites. If the firm has a lot of debt and it has to make high debt payments, it won't have a lot of free cash flow left to consume perquisites. But if the firm is 100% equity financed, then there are no such required fixed periodic payments, and the managers have a lot more free cash flow with which to waste the firm's money. And whose money is it really? The shareholders. So, can these costs of debt be reduced? Well, we try to do so through something called protective covenants. And protective covenants are written into the bond indenture. Now, bond indentures are actually written by the borrower, unlike the kind of consumer lending you're used to. And the reason this has to be the case is because with consumer lending, there is one borrower and one lender. The lender can write the terms. But with bonds, there is one borrower and many lenders. Getting many lenders together to agree on something would be nearly impossible. And so what the borrower has to do is put together a bond indenture that they think will be attractive to bondholders, and thus lower their cost of financing and increase the marketability of their debt. And so what could they do to achieve these things? Well, anything that lowers the risk to the bondholder would be considered a positive. And if there were activities in which we did not plan to participate anyway, if we were pledging not to be scumbags, then it's not going to hurt us to promise not to do these scumbaggy things. And that's where protective covenants come in. First of all, let's talk about limits on dividends. We've already mentioned that the firm could, in a big scumbaggy way, pay out all of its cash to its shareholders in a big dividend. Well, if there's an indenture that prevents them from doing that, then bondholders don't have to worry as much about that, and they won't require as much return to hold the firm's debt, thus lowering the cost of borrowing. The firm may not pledge assets to other lenders. Right now, I owe money on a house, and I could not go out and borrow the full amount for the house again from another lender because I have already pledged this asset, my house, to the original lender. If we have someone who pledges their house to 3 different lenders, then fights break out when the person inevitably declares bankruptcy, and now people have to fight over the leftovers. And so to avoid that, we can say, hey folks, we pledge not to borrow money from anyone else using this asset as the security. Then we may also throw in there that firms may not merge. Now, keep in mind that this is like a cafeteria or buffet situation. We don't have all of these things in every bond indenture. And here's why. For many firms, part of these things could be part of their business strategy. For instance, merging. General Electric was successful over many years by continually buying and selling businesses. So you would never see them put this particular covenant in their bond indenture. Now, why would we not want firms to merge? Let's picture 2 firms. My firm is very safe. I provide milk for school children on a fixed price government contract. Actually, it's a cost plus, meaning that I'm guaranteed a profit. Then my brother-in-law has a company doing nuclear waste cleanup. He's got a much riskier proposition there. As a result, my bondholders only require 6% return, but my brother-in-law's bondholders require a 12% return. But what if we merged our 2 companies together? Assuming they were roughly the same size, we would expect the bonds now to require 6% return. No. We would now expect the bonds to require 9% return. What does that mean for my brother-in-law's bondholders? Well, as the required rate of return drops, the value of their bonds will rise, and they are quite happy about that. On the other hand, what happens to my bondholders? Well, their rate of required return goes up, so the value of their bonds go down. This is a pure wealth transfer from the bondholders of the safe firm to the bondholders of the risky firm. And that is why you would not want to have your firm merge with other firms, especially if they are a relatively safer firm. Then we may also see them pledging not to issue additional long-term debt. Now, once again, this one's probably fairly rare because companies issue new debt all the time. But if you had no intention of issuing additional long-term debt, you could throw this one into your covenant. And the reason this is good for bondholders is that the less money you owe, the more likely you are to be able to pay them back. Then we can pledge to maintain a minimum net working capital. And the reason we would want to do this is because we need enough cash to make those coupon payments on the debt. Additionally, we want to have enough cash to pay our suppliers, because it turns out the suppliers can force us into bankruptcy just like long-term debt holders. So if I fail to make my payment for a shipment of lumber, that lumber supplier can force me into bankruptcy, and the bondholders will be dragged with them. And so we don't want that as bondholders, and so I might, as the borrower, pledge to maintain a minimum net working capital to avoid such a situation. And then finally, I might provide, in fact, legally required to provide financial statements to lenders. And not just financial statements, but audited financial statements. Why do we need audited financial statements? Because people are scumbags, and they would gladly give you a falsified financial statement if it helped them to enrich themselves. Now let's talk about another way that we might lower our cost of borrowing. Instead of borrowing from a bunch of different lenders, what if we borrow all of our money from one lender or from one consortium of lenders? In this case, we only have two parties at the negotiating table instead of many parties at the negotiating table. And so this would undoubtedly reduce the cost of bankruptcy if bankruptcy were to occur. Okay, now we have been talking about this impact of financial distress, and basically the expected cost of financial distress goes up with the amount of debt in our capital structure, because the probability of financial distress goes up with the amount of debt in the capital structure. That's why the expected cost of financial distress goes up. And so you might say, well, if we're just trading that off against the tax benefits, all we would have to do is create an equation and set it to where when we have one more dollar of debt added, that the additional tax shield was exactly offset by the additional expected cost of financial distress. Well, that sounds great, except for one problem. It's very, very difficult for us to come up with the true expected cost of financial distress. And so we basically are left shooting in the dark here. Students are always surprised to learn how little we actually know in finance and basically any of the sciences. But this is one of those things that we don't know. We have some empirical evidence from individual cases, but for the most part, we do not have a rigorous theory that allows us to calculate the expected cost of financial distress. Let's take a look here graphically and try to think about how this works. We've seen this picture before. We've seen this picture without the red line. And this is basically Modigliani and Miller, including taxes. In other words, the higher the proportion of debt in the capital structure, the greater the value of the firm. But once again, we said that basically leads us to the conclusion that every firm should be running on at least or close to 100% debt. But we don't really see that in the real world. And so when we start working these expected costs of financial distress into our thinking, then we come up with the red line. And so we see in the beginning that the tax benefit is growing, but of course at very low levels of debt, the possibility of financial distress is still quite low. But at some point, we start to see that the expected costs of financial distress actually start to reduce the value of the firm. And so there is an optimal capital structure that places us here at the maximum value for the levered firm, considering these expected costs of financial distress. So theoretically, any firm out there has an optimal level of debt. I say in theory, of course, because once again, we have no rigorous formula to be able to calculate this optimal. So what do we end up doing? We end up trying to infer what this optimal debt level is by looking at other firms in the industry. Now, especially if we've got a mature industry where people have been around for quite some time, for instance, electric utilities, it makes a lot of sense to look at these because the firms that are in the market have survived a long time. If they were making poor decisions with their capital structure, they probably wouldn't still be around. But over time, they have played with capital structure until they've come to the optimal amount. And so if you're going to go start a new electric utility today, you would set the industry average debt to equity ratio as your target debt to equity ratio and try to maintain that, because that would be apparently the optimal capital structure for your industry. So taxes and bankruptcy costs can be viewed as just another claim on the pie. Remember, in a world without taxes, we were talking about the proceeds of the firm, the cash flows going to the debt holders and the equity holders. And then once we introduce tax, now we say, well, we've got to give some money to the government too. But we give less money to the government when we have debt in the capital structure because of the tax shield of the interest deductibility. Well, now we say, wait a minute, there are actually some more claimants to this pie. Now we've got the government and the bankruptcy lawyers. And so the government would be the taxes, and then the bankruptcy lawyers we're going to represent as L. And so we're saying the value of the firm now is the cash flow goes to the stockholders, the bondholders, the government, and the lawyers. And so the essence of Modigliani and Miller's intuition that the value of the firm depends on the cash flow of the firm stands firm. The problem is we haven't been adjusting for these additional claimants on that pie. And so our choice in capital structure merely decides how these things are going to be divvied up. It does not impact our investments or the cash flows from those investments. So here is a graphic representation of what we were just saying. We still have shareholder claims and bondholder claims, plus the tax claims, but we also have our bankruptcy claims. And those bankruptcy claims, we'll get into in a minute who all the people are that we must pay off in bankruptcy. Now let's talk about signaling. Just saying something is not what we consider a credible signal. I'll give you an example. I have seen many CEOs after the closing bells on CNBC saying that their company is doing well and that they are looking forward to great growth opportunities and there's some really interesting, cool things coming down the pipeline. And then at 12:01 a.m. Eastern Time, that very same night, their company submits paperwork for bankruptcy. In other words, the CEO was lying through their teeth. People lie. People are scumbags. People lie. And so if I want to tell you something and you know it to be true, I have to be able to signal it in a credible way. I have to be able to signal it in a way that's costly to me. So let's talk about using debt as a signal. So the firm's capital structure is optimized when the marginal subsidy to debt is equal to the marginal cost. Now, what are we saying there? That's the trade-off thing we've been talking about. When that additional dollar of tax shield is exactly offset by an additional dollar in the expected cost of financial distress. And so investors are going to view debt as a signal of firm value. Because if the firm is going to have a lot of earnings, it will have a lot of earnings that it needs to protect from taxation. And how could it protect those earnings from taxation? Take on debt. And so taking on debt might be a sign of higher anticipated profits. But what about the firm with low anticipated profits? Such a firm would not have need of the tax shield provided by debt, and as a result, they might not take on debt at all. And so, therefore, issuing debt becomes a signal that the firm has higher anticipated future cash flows. Now let's think about this. You say, well, wait a minute. A low anticipated profit firm, all they have to do is go out and take on a lot of debt, and they could falsely signal that their firm had higher anticipated future cash flows. Well, that's true. But the question is, how long can they do that? Because if they've got just low cash flows, they'll end up owing more in interest than the cash flows are that are coming in. And so you might be able to short-term fool the market, say for 6 months, but you're not going to be able to hold out for very long doing that. And so it's only truly the healthy firms that are able to signal using debt in this way. Now let's talk about the agency cost of equity. We all know that people work harder for themselves than when they're working for someone else. If you've never had a job, maybe you didn't experience this, but having been a former supervisor, I can tell you with certainty that my workers worked harder when they were on their own time working on their own projects than when they worked for me. You also have managers who are looking for opportunities or motive to take part in perquisites. In other words, to enjoy wasteful spending that brings them pleasure but no benefit to the shareholders. But they also need the opportunity to be able to do that. And free cash flow provides this opportunity. Well, what's free cash flow? Free cash flow is the cash flow that is left over after the earnings of the firm have been used to invest in every possible positive NPV project available to the firm. So what should happen to that free cash flow? Well, first of all, let's ask, who does it truly belong to? It belongs to the shareholders. And as a result, it should either be used to repurchase shares or pay out a dividend. But what if a manager wanted to hold on to that money? Then they might be able to buy a corporate jet or refurbish their headquarters or do something that would not bring value to the firm but would bring pleasure to themselves. And so this free cash flow hypothesis says that if we increase dividends, that should benefit the stockholders by reducing the ability of managers to pursue wasteful activity. And similarly, we argue that debt will reduce the ability of managers to pursue wasteful activities more effectively than dividend increases. Let's talk about why this is. Remember that debt is a fixed cost, fixed claim form of financing. In other words, I have to pay the same amount every month or every 6 months, depending on whether we're talking about a bank loan or bonds. But I have to make that payment regardless of what's going on at the firm. And I have a legal obligation to pay. It's actually a liability of the firm. Now with dividends, the corporation doesn't truly have to pay those. They could raise the dividend now and then lower it later. And so debt is a more credible long-term certification that the managers are not going to be wasting your money versus merely raising the dividends. Now, what about the share repurchase? The share repurchase gets rid of free cash flow too, but it's even less credible of a certification than dividends, because at least with dividends, when you lower dividends or stop paying them, the stock price gets punished. With share repurchases, basically you do it once and there's no commitment to continue to do it in the future. So let's talk about the pecking order theory. Now we're shifting here. We've been talking about the trade-off theory. Now we're going to talk about the pecking order theory. And this theory says that firms will issue debt rather than equity if their internal financing is insufficient. So what is rule number 1 of the pecking order? It is to use internal financing first. Well, what is internal financing? This would be the addition to retained earnings of the firm, also known as internal equity. And if we don't have enough of that, then we would issue the next safest form of financing, which would be debt. So we're talking about safe to the investors. And then we would issue new equity last. Now let's talk about what motivates the pecking order theory. It's adverse selection. Adverse selection, it happens when you've got two groups of people with different sets of information. Let's use the classic example from the insurance industry. This morning I woke up with a really bad cough. In fact, I was coughing up blood. And my wife said, "You really need to go see the doctor." And I said, maybe I'll go see my insurance agent first. And so I wipe the blood off of my mouth and I drive down to my insurance agent, trying very hard not to cough. And I lower the deductible on my health insurance. I raise the maximum. And I also double my life insurance. And then I proceed on down the road to the hospital. Now, who had superior information in that case? I did. I'm the patient. I know what's wrong with my body, or at least I have a strong suspicion. The insurance agent was taken advantage of there because of his lack of information. Now, how does that apply to our situation? Who has the superior information? Well, it would be the managers of the firm. The managers know what's going on better than anyone else in the firm or outside the firm. So when are managers going to want to issue equity? When the equity is overvalued. And so anytime we see the firm issuing equity, it would be a signal to the market that their equity is overvalued. Now, what if, though, the firm chooses to use its internal funds first? That says that they think they've got good projects coming down the road and they don't want to share with anyone else. Now, let's assume that if they run out of money on internal funds, then they could go out and borrow money. Why would borrowing money be good? Because now we're bringing in these outsiders, but we're only giving them a fixed amount of money. We get to keep all the extra. What does this lead the outside world to think? Aha, there's going to be plenty of outside or of leftover money for these shareholders. That's why they're issuing debt. But what happens when I issue additional equity? Now, instead of people assuming that I'm sharing something good, they will assume that I'm sharing something bad. Do people like to share bad things? I know we don't like to think of it this way, but people absolutely do. For example, do you remember the phrase, misery loves company? It comes from somewhere. So what does all this lead us to? It leads us to the conclusion that the most profitable firms borrow less, not because they have lower target debt ratios, but because they don't need external financing. So how do firms actually establish their capital structure? Well, when you go out there and look, most corporations actually have a fairly low debt-to-asset ratios. Most firms actually have a low debt-to-asset ratio. And when we say low, we're comparing to what would be under Modigliani and Miller. And so what's leading to this? Well, we know that changes in financial leverage will affect firm value. So stock price increases with increases in leverage and vice versa. Now that one is consistent with Modigliani and Miller with taxes. Now we've got to be careful there because what if the firm takes on too much debt? Then we've got the expected cost of financial distress and the value of the shares will actually drop. One of the more important things that we see, though, is that there are differences in capital structure across industries. For example, you may see banks running at 90% debt to assets, which is usual. Electric utilities running at 50% debt to assets, and then you get down to biotech and they're running at 0% debt to assets. That's because the different characteristics of these firms lead them to different optimal capital structures. And we do have evidence that firms behave as if they have a target debt to equity ratio. What do we mean? It turns out that within an industry or for a firm, that levels of leverage or debt are mean reverting. What does mean reverting mean? It means they go back to the average over time. How then would we interpret that average? We would interpret that average as our best guess of the firm's target debt to equity ratio. So what would the factors be in coming up with a targeted debt to equity ratio? Well, first of all, taxes. Interest is tax deductible. More highly profitable firms should use more debt because it gives them a greater tax benefit. So that's one thing we would be looking for here. Then there's also the type of assets. Think about how different assets perform at bankruptcy. What if I have tangible assets like buildings and equipment? Those things tend to have a higher percentage recovery of their value at bankruptcy than intangible assets like copyrights and research and development. And so firms like electric utilities will borrow more money than the biotech firm, which basically has nothing but intellectual property. In bankruptcy, the costs of financial distress are higher for firms with more intangible assets, and as a result, those firms will rely less on debt in their capital structure. And then there's the uncertainty of the operating income. Remember that debt represents fixed payments that the firm has to make along the way. As long as cash flows are high enough, we can always make those debt payments. We could have two firms with the same average level of cash flow, but if one of them is more uncertain than the other, the one with the more uncertain cash flows will have a lower level of debt in its capital structure. Why? Because there's a bigger chance that the incoming cash flows will dip below the amount of cash required to meet the debt obligation. And so the more volatile a firm's operating cash flow is, the lower amount of debt you'll see in their capital structure. And then we think about the pecking order and financial slack. Well, so the theory states that firms will prefer debt rather than equity if internal financing is insufficient. And that really doesn't lead us to a good prediction of a target debt to equity ratio, because basically the pecking order is all about timing. I know that I've got a project. If my timing is great, I have the internal funds to handle it. If my timing is not great, then I might have to go outside for that funding. And if the project's really huge, I might have to go all the way to issuing equity in order to do that. So we see that there's really no way to come up with a target debt to equity structure from the pecking order theory. Now let's talk about financial slack. We might think that having too much cash on hand is a bad thing, and we would be right. But there is such a thing as financial slack that is necessary for things to run smoothly at the firm. This gives us cash on hand to handle unexpected things and also to jump on opportunities when they present themselves. For example, I don't like to keep very much money in my checking account, but my wife likes to keep around $500. And I like to keep around $100. That additional $400 in financial slack has more than once kept us from having a problem. In other words, I could go ahead and write a check for something that we needed that I couldn't have otherwise. Now, would it make sense for me to keep $100,000 in that checking account? Absolutely not. And so this is something that companies need to work at, is finding the optimal amount of financial slack for their firm. So let's take a quick look at the bankruptcy process. First of all, let's talk about what a business failure is. The business has failed if it has terminated with a loss to creditors. What if instead we basically lost all of the shareholders' money but managed to make the creditors whole? Then that wouldn't be considered a failed business. Now, this is a theoretical explanation, whereas there's also a legal idea of bankruptcy, and that is when we petition a federal court for bankruptcy. Now, it turns out that petition can come from two places. Number one, it could come from the people we owe money to. If we haven't paid them, they can petition the court to force us into bankruptcy. Or number two, if we see we are going bankrupt, we might petition the courts ourselves. And in fact, most of the big bankruptcies you hear about anymore, the company has itself petitioned the courts for bankruptcy. They're doing this to protect themselves, to try to get protection from their creditors while they work through the bankruptcy process. Now, technical insolvency is when the firm is unable to meet its debt obligations. And in its purest form, we would talk about they could be in violation of a bond covenant. And if they were in violation of that bond covenant, then they would be also able to force them, the supplier could force them into bankruptcy. The creditor could force them into bankruptcy. And then there is accounting insolvency. That's where the book value of the equity is negative. And you can use your stock screener from whoever your broker is and go out there and find companies that have negative book value of equity right now. And those companies are not undergoing legal bankruptcy. And so you can be insolvent from an accounting perspective and still be staying in business. Now let's talk about the bankruptcy process. And you hear two chapters mentioned a lot, Chapter 7 and Chapter 11. Chapter 7 is my favorite because it's liquidation. Basically, we are selling off the assets of the firm and paying off the creditors as best we can. Why is that my favorite? Well, it puts an end to managers destroying value. Now, how does it work? The trustee, which is appointed by the court, takes over the assets and sells them and then distributes them according to the absolute priority rule, which we'll discuss here in a minute. Now, the other that we hear about is reorganization. And this is also referred to as Chapter 11. By the way, this all comes from a law that was passed in 1978. What does reorganization do? Well, it allows you to restructure the corporation with a provision to repay creditors. So let's talk about why reorganization, so it would be less good for creditors unless they thought there was some way that the reorganization would get them a higher payout than the liquidation. But in truth, creditors probably do not wind up with a better deal out of a reorganization. Then why would the courts and the law allow it? Well, one of the arguments that was made, and by the way, I remember when this law was passed, one of the arguments that's made is that a firm can protect more jobs when going through reorganization than through liquidation. Imagine a retail store chain. If they had to liquidate and sell all the stores, they would have to fire all the employees. But what if they were allowed to reorganize and shutter a certain number of stores? They might be able to maintain the employment of people in those stores and maintain employment at the corporate headquarters. And so especially in times of higher unemployment, you'll hear reorganization spoke of more positively than in times when we have low unemployment. So what is this absolute priority rule? Well, first of all, let's clarify something. It's called absolute, which means that it can't be changed and it's always followed, but that's not true. Because oftentimes in these bankruptcy proceedings, there are negotiations, and in those negotiations, the parties might agree not to follow the absolute priority rule. And some of the parties might not agree, but if they are overruled by the majority of parties, then they might get kicked out of this absolute priority rule situation. And of course, they would not be happy about that. But let's talk about what should happen. Well, first of all, there are the administrative expenses of bankruptcy. We've got the cost for the lawyers. We've got the cost for the bankruptcy trustee. Those are the first that are settled. And then there are the wages, salaries, and commissions owed to the employees. What if the company goes bankrupt on the 27th day of the month and they always pay on the first day of the month? That means the employees will have worked for 27 days and will be owed money. Those employees are second in line after the lawyers and the bankruptcy trustee. And then there are contributions to employer benefit plans. For example, if the company does a match to your 401k, or they pay into a pension fund for you, or they pay part of your health insurance, all those things would be third in line. And then we have the consumer claims. I ordered a brand new drone from this company, and then they declared bankruptcy. And so now they owe me $500. Well, if there's still money left over after the employee benefit plans get their money, then maybe I will get my money for my drone. And then there are government tax claims. I am totally shocked not to see the government at the top of the list, but here they are at number 6. Any taxes that the firm owes would be paid at this time. Now, firms that are going bankrupt are not likely to owe a lot of taxes simply because taxes are based on the firm's profit before taxes. And if they're unprofitable and that's caused bankruptcy, then we'll have the situation where the taxes really aren't that big of a deal. That's followed up by the unsecured creditors. And you may be saying to yourself, wait a minute, where are the secured creditors? We're going to talk about them in a minute. Then after unsecured creditors come the preferred stockholders. Preferred stock has a liquidating value of $100 per share. And so we must pay our preferred shareholders $100 per share before the common stockholders get anything. Now, my dad has owned stock in 4 companies that went bankrupt. I've owned stock in 2 companies that have gone bankrupt, and neither one of us have ever seen a penny out of one of these bankruptcy processes. And so do not think that you'll get much at all if you are a common shareholder, because after all, you're the residual claimant. You get the leftovers, and in this case, there probably aren't going to be any. Now let's talk about where secured creditors are in this whole order. The bankruptcy trustee takes the assets that are being used as security for these loans and sells them. If the money is exactly enough to cover the secured creditors' claims, then the secured creditors are paid and they go away happy. If it is not enough, then that remaining amount gets thrown in with the unsecured creditors here at step 6, where the unsecured creditors and the unpaid portion of secured creditors have to fight it out for money at that level. And if they manage to get more for these assets that were acting as security than was owed to the secured creditors, then that excess money is thrown into the pot to compensate the unsecured creditors. And so we see a situation here where secured creditors and unsecured creditors, they're kind of jumping back and forth as to who's getting whose cash flow.